Good evening, everyone. Thank you for taking time out and joining us for this session with Mr. Sunil Singhania. And this is a wonderful time to speak about India, India's story. India has been shining bright for over 3 years now, and the market dynamics is fast evolving. While the India's position is evolving in the stacking order, the domestic growth story is evolving at a faster pace. And there is emerging themes like digitization, geopolitical situations, which is transforming as we speak. To get a grip on this new age dynamics in the light of the market outlook and the underlying investment themes, we are glad to have an industry stalwart to speak us about this today. Uh, Today, I'm joined by Mr. Sunil Singhania, who's the CFA and founder of Abacus Asset Management, India-focused asset management company established back in 2018, Prior to this role, he was the global head of equities with Reliance Capital, today, which is known as Nippon Asset Management, where he oversaw the equity assets of over 16 to $20 billion and provided strategic input as a CIO. So, without much ado, I will hand over to Sunil uh, for today's session. So, over to you, Sunil. First, we would like to hear from you about the Indian markets, how the markets looking like both in short term and long term. And this is a very interesting year since it is elections worldwide, including India, US. So, how do you see this year panning out and a long term uh,
Sure.
growth story for India? With that, I will hand over to Sunil.
Thank you, Manish, and thanks everyone at HSBC for giving us an opportunity to, be an esteemed partner with yourself, as well as giving us an opportunity to speak and give our views on the market. Interestingly, it is one of the most interesting and volatile weeks we have had after a long, long time, and therefore, I don't think this webinar could have been timed more better. Coming on the overall market, I always go back and I say this that last 3, 4 years, the world has seen things which we had never ever seen for a long, long time. We started with COVID, which was a once in a century kind of event. We had a war, which was, after World War II. I think it was one of the most tumultuous sort of years with Russia, Ukraine, and Israel, Hamas, and in between, even China, Taiwan rearing its head. We have had institutions like Credit Suisse going belly up, and multiple small, small things which kept on happening, including a 3, 4 decade high inflation, as well as the sharpest interest rate hikes in the US for again 3, 4 years, where interest rates were hiked by almost 450 basis points in a matter of 4, 5 months. And amidst all this, if you would have spoken to and I would have told you that in the next 4 years, all these things are going to happen, I'm very sure you would have sold all your equities and you would sold even your neighbor's equity. But lo and behold, despite all this, I think India has come out really, really shining. And whoever has been positive has had good health, good wealth. And obviously, if you have good health and good wealth, then a lot of smiles. And I think that has been the story of India. And again, I always say this that in 2022 and 2023, when the world was debating whether there will be a recession or 0% growth, in India, the debate was whether we'll grow at 6% or 7%. And we all know which is a better debate to have. In fact, India ended up growing upwards of 7%. And the next 2, 3, 4 years perspective and expectation is also India growing almost at 7% plus. And I think that has really, really brought India into the limelight, that in a scenario where the world is degrowing or hardly growing, India has managed to grow at 7%, and even the outlook is looking like 7%. Our view is that this is a combination of the 4 Ds, what we call. First is the democracy. I think in a world where wars are the order of the day and autocracies and one men ruling the countries, like what is happening in China and what is happening in Russia, increasingly global investors who have lost almost 100% of their investment in Russia, and possibly, if something were to happen in China, that is also a possibility, have started to believe that democracies are the way to go. And across the board, I think markets where there are democracies have ended up doing much better last 2, 3 years than others. The second has been the demographics. I think we all know that young population is genesis for growth. China is already aging. India, even today, has a median age of less than 30 years. And even after 100 years of independence, which is 2047, the expectation is that our median age would be somewhere in the region of 33 to 35 years. And I think that gives us a lot of room for sustainable growing at upwards of 6.5, 7%. The other thing is, out of the 140 crore population which we have in India right now, roughly one third, which is around 45 crores, is able to afford some want. The balance 100 crore odd are just struggling to meet their roti kapda or makan, or just about struggling to meet their needs. I think in the next 8, 10 years, this is going to change dramatically. So out of the 150 crore people we'll have maybe after 8, 10 years, almost 100 crores would have graduated to a income level where they will be able to afford some want, and only one third would be in that need-based kind of a income bracket. And I think this move from 45 crore, those who can afford wants, to 100 crores is almost the entire population of US and Europe put together. So because of this demographics, I think there is clear visibility that the growth in India is sustainable for a long period of time. The third D is what we call the domestic economy. I mentioned to you earlier that when the world was struggling to grow at 0% or avoid recession, India was growing at upwards of 7%. That is largely because, 80 to 83% of our economy is domestic. We don't depend too much on exports. And therefore, when Europe and US were not growing, our industry, our economy was not impacted as much because we're not too much of a export dependent economy. In fact, if you remember last 2-3 years, we would have celebrated weddings, birthdays, anniversaries, holidays, shopping like never before. Everything is full, largely because of the domestic nature of our economy. And the fourth D is the digital economy. I think what we lag in terms of physical infrastructure, I think India's digital economy has done wonders. And the reason why this tax collection are growing at 18-20% is largely because of the huge absorption and adoption of the digital infrastructure. Tax evasion is very difficult. We have all become very efficient. And I think these 4Ds have ensured that on the economy front, India is really standing out. Coming secondly to the election perspective, we have elections coming up. I think tomorrow the election commissioner is going to announce elections. Between April and May, elections should be held. I think the discussion would be more on the margin of victory, and it is seeming to be a foregone conclusion that we will have a third term for the current government. And interestingly, that would make India maybe the only large democracy in the world. And as you rightly said, Manish, there are so many 50-60 countries having elections, but India would be the only economy in the world which will have the same prime minister, the same government for 15 years. And it is very important, because what we see in the US, where they can't find a third person other than the two who are already fighting, or UK, where, prime ministers are changing every 6 months, or even some other countries where, there has been a lot of volatility. I think having the same leadership does help because there is consistency on your process, consistency on your path forward, and so on and so forth. Third thing, on the corporate profitability front, things have been phenomenal. Even during COVID, I think Indian corporates adapted well. We have seen a great September result season, a great December result season. March results are also expected to be pretty decent. And going forward across brokerages, it's expected that there will be a 15 to 18% profit growth for FY25 as well as FY26. And that would mean that the Nifty PE is now at 1135 for FY25 and 1300 for FY26. At 22,000 Nifty levels, that means that Nifty is trading around 17 times FY26. So, we are not cheap. We are like 5% higher than the long-term average, but we are not exorbitantly expensive. We are not at like 25p or 30p that people should be worried about a bubble kind of a scenario. And given the fact that the profit growth is expected to be 15-18%, our view is that there is a very big likelihood of Indian markets generating mid-teen kind of returns going forward. From a global perspective, things were a little hazy. We all know October 23, the markets globally corrected because US yields had touched 5%. Since then, there is very clear consensus that both on the inflation side as well as interest rate side, we have reached the peak, and from here on, both can only go down. Whether US Fed cuts interest rates in the next 1 month or 2-3 months, we don't know. But it is not whether, it is a question of when. And I think the markets are also taking a cue from there, and global markets have also been pretty stable to strong over the last 4, 5, 6 months, and the trend is expected to continue. From a growth perspective, growth in the US and Europe region has been very, very subdued, particularly the Euro region. Initial indication coming over the last 1-2 months point to some uptick, some recovery. We are still far from the peak, but there is definitely some recovery which is seen both in Europe as well as US. And it is expected that over the next couple of years, hopefully there will be some semblance in terms of the economic scenario there. So I think all in all, we are in a very decent kind of a situation. And at least on the visible front, we don't see too much of a stress as far as the economy and the markets are concerned. On the market front, things have been good, as I said. Last 5-6 months, things have turned a little bit hot, to some extent euphoric. Euphoria is predominantly in theme-based investing. So, anything to do with railways, anything to do with defense, anything to do with smaller PSUs, IPOs, electronic manufacturing services, EVs, renewable energy. They've all been the themes, and speculation has been more on thematic bets rather than on fundamentals. And I think what we have seen over the last 8-10 days in particular is a correction of those excesses. There have been like almost 400-500 stocks which have fallen anywhere between 25% to 50% over the last 10-15 days. But if you go through the stocks, you will find that most of these stocks anyway, were not on the investment sort of a horizon as far as institutional investors are concerned, and it was predominantly the retail which was active on it. It is also good because froth to a large extent has been removed. The markets are still, I'm not saying that we have made the bottom, but a lot of excesses have been removed. And from here on, at least for the next 2-3 weeks, our view would be that the markets will be in a range with spikes of 2% up, 2% down, which we also saw today. But it would sort of consolidate. Sentiments have also been hampered because of regulatory issues. I think RBI has been very, very tough, and he has come out with added warnings on mid and small cap with some stress test and so on and so forth. March anyway is a little bit of a subdued month because of advanced tax payments, so liquidity gets sucked in. It's also subdued because particularly margin trading guys, they want to clear all their books, and therefore, no new transaction gets done towards the second half of March. It's an annual phenomena. Our view is that all this would get settled in the next 2 weeks or so. And, as the elections become closer or come closer, you'll start to see some optimism as far as markets are concerned. Having said that, we are very clear that the last 3-4 years returns of 20, 30, 40% CAGR were great returns, but we cannot extrapolate them going forward. Our view would be that at least from a large cap side, one should expect anywhere between 12 to 15% return, with slightly higher returns coming from mid and small cap side. Anything to majorly worry doesn't seem to be the case. The only one disclaimer here is that large corrections in the markets always happen due to events which we are not able to foresee, like COVID or the war or Credit Suisse. And if something which is non-foreseen happens, only then we can see a large correction. Otherwise, I think we are in a pretty decent scenario. One thing I would like to highlight is if you go back, 2014 to 2019, which was the first term of Mr. Modi, that went into cleaning the system. So we had the NPAs of the banks, which were very high. Those needed to be cleaned. The government experimented with deep mon, which took away like 1 year to stabilize. And then once it stabilized, we also had GST, which got implemented, which again took 12 to 18 months to stabilize. So the first 5 years was actually in cleaning the system and creating foundation. The second 5-year term, 19 to 24, couple of years just went into the COVID scenario. It's only in the last 2.5 years that we have seen a big push towards PLI. So like electronics, almost all electronics are now manufactured in India. Apple iPhones are being manufactured in India. Intel has tied up with 12 manufacturers to manufacture laptops in India. Tesla and the likes are all being encouraged to set up shop in India. Only today there's been an announcement of some tax benefit, and we hope that Most of them will set up shop as far as India is concerned. And you have multiple other sectors where PLI was introduced. Make in India, particularly on defense, railways, a lot of focus on infrastructure. So 10 lakh crore was the allocation on infrastructure in the last budget. This budget, we had 11 lakh 11,000 crores. Our expectation is that every year there will be a 10% increase, and that would mean that over the next 5-year term of Mr. Modi, which is 24 to 29, you would have almost 65 lakh crores, a huge 65 lakh crores being spent on infrastructure. Incidentally, the 65 lakh crores is higher than what we have spent over the last 78 years put together on total infrastructure building as far as India is concerned. So what we have built over the last 77, 78 years potentially will be built over the next 5 years, 6 years. And I think that can be an upside if all these happens. To complement that, private sector capex also, which was muted, is now showing signs of picking up. And we expect that over the next 5 years, even private sector capex can be anywhere between 50 lakh crores to 60 lakh crores. So that could be another big advantage. Obviously, we all know this China plus one is working. A lot of countries are encouraging imports away from China, and India has been a beneficiary of that. We are also seeing, in India, import substitution being encouraged in a big way across sectors. And I think that is also going to help. There is an added sort of a thing of Europe plus one, because Europe suddenly is becoming non-competitive as far as manufacturing is concerned. And particularly in sectors like heavy engineering, chemicals, India is coming out as a major sort of a sourcing base for countries as far as Europe is concerned. So that can also be a key positive. So I think the next 5-year outlook also is pretty decent. From Abacus perspective, just a few things. We are very clear. We are very fundamental focused. So our key investment philosophies are follows. We are investors. We are not allocators. And there's a difference between investors and allocators. So very clearly, if you see a lot of portfolios, you will see a similar kind of stocks. Asian Paints, Bajaj Finance, Hero, HDFC Bank, Kotak Bank, Infosys, Reliance, and you are done. We call it allocation. We don't call it investment. From our perspective, we are investors, whether it's large cap, mid cap, or small cap. Second is we are balance sheet focused and fundamental focused. We don't invest in loss-making companies. Our view is that if someone wants very fast-growing technology companies which are not making profits, they should be investing it through a private equity fund rather than a listed fund. And from our perspective, it's all about profits of the underlying company. Third is we have a very strong research team, almost 17 people, cumulative work ex of 225 years plus. And that gives us the confidence of not being afraid to be the first or the only company in a particular stock. And therefore, if you see our portfolio, you'll find a lot of different stocks because we believe in internal research. Fourth, we believe that we are agile and flexible. We don't get fixated by a particular way of investing. We are open to investing in any sector as long as it fulfills our fundamental criteria. Fifth is we are buy and hold investors. We believe that buying a stock is like becoming a partner in the company. And therefore, we would only invest from a 3-4 years perspective. Last, which is very important, is that the best stock is not necessarily the best the best company is not necessarily the best stock if it is priced beyond perfection. And I always give this example of Asian Paints, great company, great brand, but trading at 60-70p multiple and growing at 10-11%. Now, to even make 10% return, Asian Paints will have to trade at a 60p multiple all its life. And just to give you a perspective, last 20 years in US, there have been only 5 companies. In 20 years, there have been only 5 companies which have traded at a P multiple of more than 50 times for more than 5 years. And you know how technology-savvy companies in US are there, and that would include the likes of Microsoft and Google and Meta and every other company you can put together. Only 5 companies who have traded at a P multiple of more than 50 for more than 5 years. So I think this investment philosophy is sacrosanct for us. We don't invest in any company where the return on capital employed / return on equity is less than 14-15%. We ideally like to invest in companies where profits can double in 4 years, maximum of 5 years. And typically at the portfolio level, we like the PE to be somewhere in the region of 15, 16 times or below. And all our strategies, we have been able to maintain that. Coming to the ecosystem, we are now 100 plus strong, 100 plus people in the organization. As I mentioned, 17 on the investment side. In terms of what we do only India, we do only equities, we do only long only. So we keep it simple. We don't do global equities. Our view is that India offers a better option to grow. We know India. We do only listed. We don't do unlisted stuff. And we are long only. We don't short. From strategy perspective, one strategy which we have is called the all cap strategy. It's a combination of large cap and mid cap. Very clearly 35-40% large cap, the balance larger mid cap. The idea would be to generate alpha, at the same time reduce volatility because of the exposure to large cap. The second strategy which we have, which has done phenomenally well last 3-4 years, but obviously, it's an out and out mid and small cap strategy, is what we call the emerging opportunity strategy, which is 50% mid cap and 50% small cap. Huge alpha opportunity. At the same time, it will be much higher volatility. And the last strategy is what we introduced only 2-3 months back. Normally investors used to get confused whether to put in large cap or mid cap or small cap. So we said that let us devise a product which is an all-weather product, and that's how we devised the Diversified Alpha Fund, which we also call the 40-30-20-10 fund. To put it simply, it has 40% large cap, 30% mid cap, 20% small cap, and 10% micro cap. So the large cap gives stability, the micro cap and the small cap gives alpha. So these are the three strategies. You have the presentation of all the strategies, a short view on the market. More than happy to answer any question at this point of time. And I think that would also make the interaction more, I would say, energetic.
Yeah. Thanks, Sunil, for your views on markets, on economy. Now, Sunil, so we will request everyone to ask questions. You can put your questions on Dreamcast, you can put your questions on YouTube, and we'll pick that up. So, as the questions come in, my first question to you would be, what is your top 5 high conviction sectors at this point for you?
So Manish, very interestingly, the most convincing sector for the overall market and the most, I would say, consensus sector has been banks, but that has not given any returns. So the banks have done the best in terms of profits in the current financial year, but equity market returns have been very muted, particularly the larger banks. So whether you take HDFC Bank and Kotak Bank, they have been the worst, but even ICICI and Axis and all, they have given muted returns. And ironically, the sector which everyone thought would be the worst, which is IT, actually has turned out as per the expectation, where profits have been muted, but returns for IT sector has been the best. So a lot of time what happens, the view on the sector might not translate into returns in the immediate term. Having said that, we continue to like banks because our view is that for the next 3-4 years, asset quality is under control. Credit growth should be decent because, as capex cycle begins, corporate credit will start to pick up. On the retail side also, we don't see too much of a stress. And all that means that profit for banks should be pretty decent. In fact, in one of our funds, for the first time in 5.5 years, we have bought HDFC Bank. We had zero HDFC Bank, zero Kotak for 5.5 years. So only in the recent times we have bought it, because on a P basis now, even HDFC is trading at 11.5 times. So banks, particularly the larger banks, look interesting. Capex still very interesting. Hopefully in the current correction, we might get an opportunity. Otherwise, stocks are very expensive. So anything to do with Capex, anything to do with, I would say, EPC or something, we do believe that there is a merit. We like to be equal weight for IT, and largely because, IT is one space where India has global competitiveness. And there has been concerns about AI taking away some business from IT. So we have to look at it, we will not go overweight, but we would still like IT to be there. Pharma has become very interesting. Stocks have done well, but I think there is still room, and I would classify some specialty chemicals along with pharma, because these two sectors over the last 2 years have been bearing the brunt of destocking as well as price falling, largely because China suddenly opened. I think now prices are stabilizing, even with China prices stabilizing. There is again a natural advantage to companies in this sector, because India, particularly on the pharma and specialty chemical, has global sort of competitiveness. One sector which has not done well, where we believe that things can improve, is consumer facing and building material sector. I think both these sectors have not done well. Maybe we are 3-4 months early, but this is one space where we believe with a lag, demand should revive. And I think that is one sector where we are very closely tracking it.
Thanks, Sunil. Sunil, one big question which is being asked now is about PSUs, and because PSUs have run up the most in last 6 months. So, how do you see PSUs as a play now? Do you see value, or do you see froth over there? What's your view on PSUs?
So see, PSUs can be distinguished into two types of PSUs. One, where there is no float. Float is 2%, 5%, 7%. These are smaller PSUs. There is very clearly fraud there. And it is a lot of it is pure retail. If you see the number of shareholders in each of these companies, number of shareholders has doubled in the last 6-8 months. That is clearly indicative that it is purely retail driven. I don't know what will happen, but last few days events have clearly shown that when they fall, they can fall 30-40%. Obviously, some of them have recouped some losses, but we are going to stay away from those PSUs. There are some PSUs, particularly the larger PSU banks, where there is still merit. Our view is that there we can still make higher than Nifty returns, and we have some exposure there. And on the power side, I think the largest power company on the PSU side is looking interesting, though it has also moved up. From Abacus thought process, we have limited exposure to PSU, anywhere between 5 to 9% in our funds, but it is predominantly in 2 PSU banks and 1 power company. The rest of the PSU stocks, we believe that there is still a little bit of government intervention, like what happened to OMCs today. Suddenly the government came and cut petrol and diesel price by 2 rupees in a scenario where crude is going up, largely because they wanted to do it before the elections are called, which is tomorrow. After that, they will not be able to do it. So that is the reason why they got derated today, that there is still some control. So I think you should not get too sort of, overexcited, particularly when stocks have already moved up significantly.
Sure. My next question would be on the manufacturing. So you spoke about PLI coming in last 2.5 years, and a lot of manufacturing being shifted to India. And a lot of manufacturing is getting into, again, something like PSUs related sectors, which is defense, railways. So what's your view on manufacturing, and what's your views on some of the PSUs which are in manufacturing and which has already moved up like 6-7 times in last 1 year?
So, again, what is happening is what is good on the face of it has been lapped up left, right, and center. So manufacturing as a sector is great, but particularly the capex oriented sectors have just gone berserk. And Manish, if you see, multinational companies used to get a premium in the markets in India because there was always this perception about clean companies. And second, the perception was that at some point of time, they will delist. I think we have already seen the shock when ITC promoters sold, or Whirlpool promoters sold, or some other promoters came and sold their stock. And I think to some extent, the multinational premium logically should come off. So we would not be chasing stocks just because they are in the manufacturing theme. At the same time, I think this is a theme which is going to last for 10 years. Because for us, unless we are going to focus also on manufacturing, it will be very difficult to provide gainful employment to the young population. And I mentioned to you about the demographics. If you have such a young population, And particularly with IT now not hiring the way it used to earlier, we will have to provide them jobs with the manufacturing. And I think that is where the PLI oriented incentive by the government comes into play. So manufacturing is good, but please be aware of the valuations which you are paying. And if you actually work hard, you are able to get stocks. It's not that you're not able to get stocks. We recently bought a company which is into auto ancillary called Shriram Piston. We bought it at like 10.5 P. It's already up 50-55%. So just because there was no coverage, the stock was languishing. So I think if you work hard, you are able to get stocks. And all we need is 5-7 stocks a year. You don't need like 100 stocks new to be bought every year. But the opportunity is huge. Whether it is on capex oriented sectors, whether it is on infra oriented sectors, whether it is on the manufacturing theme, I think things are going to evolve. New themes like semiconductor. Right now we don't have any direct play, but EVs. They are all going to be like renewable energy. Solar is coming out as a big theme. Ultimately, the capacity which India will have to put will be maybe 5-7x of what we have come on in totality, which we have to do over the next 5 years. So they will evolve, and I think we are tracking a lot of these forward-looking manufacturing themes. And as and when we get an opportunity, we'll definitely look at them.
Sure. And coming on to some of the very large cap names, which has not done very well. And so a lot of people are saying that large caps will now converge to catch up with mid and small caps, because that's always our long term story has been that small and large caps merge over a period of time. So, what's your view on some of the large cap names at this point?
So I think large caps have done decently well, obviously in isolation. Obviously, if you compare it with the small cap, they have not done as well. But as you rightly said, I think these are phases. Sometimes large caps will do well, sometimes mid and small, and vice versa. Having said that, the trend over the last 10-15 years is that the small cap returns will be more than mid caps, and the mid cap returns will be more than the large caps by a small percentage point. And we don't see that changing over the next 5 years also, because by nature, the smaller companies tend to grow faster. The only thing is that returns, particularly in smaller companies, tend to be coming in spurts. So, you'll have like 6-8 months where the returns will be very good, and then they will go to sleep for 6-8 months. And then again, they will come up. And it's very difficult to time when that 6 months or 3 months of good returns are going to be. So I would again say that, if you have, I always say this as a sort of a passing thing, that equity markets are like cardiogram. As long as they are up and down, we are all alive. The only thing is that the slope should be upward sloping. So large cap, the ups and downs are lower. The slope is more gradual. Mid caps, the ups and downs are higher. The slope is a little bit steeper. Small caps, the ups and downs are very, very high, but the slope is the steepest. So depending on what your heart can take in terms of the ups and downs, I think you have to take a call. But over a period of time in a growing economy, the smaller companies will give you slightly higher return than large cap over a period of time.
Got it. My next question would be on something like you spoke about pharma industry, that pharma is looking very interesting at this point. So, do you see value in large cap pharmas or mid cap pharmas? And still, the overhang of the US FDA inspections linger very heavily on pharma. How do you see that playing out over next few years?
Sure. So 2-3 things. One is pharma, you cannot, make a generalized comment about the sector as a whole. Because in pharma, you have generic plays, then you have specialty plays, then you have domestic pharma plays. So domestic pharma plays are like FMCG, where there will be steady state 10-12% growth. I would say that they are better than the FMCG, because in FMCG, particularly in staples, there is enough and more penetration. So the growth is lower, and that's why you see the likes of Hindustan Lever and some of the other staple companies not doing anything. Pharma, to that extent, there is a decent growth. and there is under penetration. Then you have the generic exporters. I think there was pricing pressure that is now sort of normalizing. We still have to see major increases, but the hope is that we will start to see increase in prices. The specialty exporters have started to see decent growth, and across the board, I think if you see the large caps, most of the large caps, including the likes of Cipla, Dr. Reddy's, Sun Pharma, they have done decently well. Now, coming to large caps or small caps or mid caps, I think in pharma, you have to go stock specific. Obviously, the large caps will give you decent returns over a period of time, less volatility. The mid and small cap tend to be more volatile because, as you rightly said, if you have 15 plants and one plant has US FDA issue, you will not have any major problem. But for a small company which has one or two plants and that plant goes into an FDA issue, then your whole business is screwed. And I think that has happened in smaller companies. So in smaller companies, you have more volatility and you have to research more stock specific because every company has some niche products on which they are focusing on. Our view is that, yes, you have to have some exposure to large cap, but there are enough and more mid-sized companies which are becoming very interesting now with outlook really improving.
Got it. And what's your view on how RBI will cut rate this year? Obviously, there is a overhang that RBI will follow Fed and not take their own decision this year. And how does that impact some of the large banks' balance sheet, which is right now looking very well because of very large money being made on the liability side?
Right. So, I think inflation is in control as far as India is concerned. Having said that, I don't think any central bank in the world wants to jump the gun. They want to ensure that inflation is lower sustainably. They're not going to go by a 15-day number or a 1-month number. Everyone wants to ensure that it is firmly in check. Second is, I think liquidity has been therefore tightened because central bank, particularly RBI, is also wary that they can't let inflation rise in a pre-election kind of an era. And therefore, if you see, liquidity across the board has been tight. You all are a part of the bank. If you see, deposits have been, tough to come by. And most banks, large banks have also been saying that deposits or the liability side, there have been some issue. On rate cuts, I think we don't expect anything before the elections. Having said that, the 10-year yields have already come down to 7.05, 7.06, a function of inflation being under control, as also the fact that India bonds are going to be included in June in the indices, and we have already started to see decent FI flows in debt. So that is already started to get reflected in the 10-year yields. But as I said, we don't see anything in the near term. In 2024, we definitely see some rate cuts to culminate. And I think that would be the next trigger as far as the CapEx cycle is concerned, because that makes funds cheaper.
Got it. My last questions would be on some bit on commodities. So, how do you see commodities like gold and oil shaping up in this year?
So I don't know about gold this year. Our medium to long term perspective is of a weaker gold. A combination, as I said earlier, of US production being very buoyant in terms of crude, move towards non-fossil based energy sources like solar, advent of EV in a major way, and hydrogen also hopefully coming into play. As far as gold is concerned, I think across the board, commodities have been strong, a combination of, to some extent, a weaker dollar, and China also putting in some kind of a stimulus to ensure that their economy at least grows at 5%. So our view is that commodities in particular should see a decent sort of a year, and maybe gold will also participate. The only problem with gold is that in 5 years, 1 year it gives you 10-12% return, and then it goes to sleep. So we don't know what is going to happen. From an India perspective, gold was great because every year the rupee used to depreciate by 3-4%. I think that also is looking like unlikely. Last 2 years, rupee has been very stable at around 82 and a half, 83. And if rupee does not depreciate, then to that extent, the return from gold in rupee terms are not that great.
Got it. Got it. With that, I will close today's session. Thank you, Sunil, for joining us. Thank you, everyone, for joining us. It was a
Thanks a
great
lot.
session, and we look forward for many more interactions with you. Thank you,
Thank you.
everyone, for joining us today.
Thanks.